5 years. So if the company gets merged with another company, then the company ceases to exist, and therefore this 5-year period there will clearly be a violation, and therefore a possible solution would be to demerge a converted entity rather than merging. So in a demerger situation, you can still have the company with the erstwhile partners being shareholders for a period of 5 years, whereas the business would have moved to a different entity. My belief is that for involuntary acts, there is a death of partner, and because of death, if this 50% condition gets violated, it will be a good case to argue that death will not lead to a violation of the condition. Very quickly, conditions under 4714, which is conversion of a proprietary firm, more or less the same, except for the difference that the allotment of shares on the basis of capital balances is not relevant here. So there is only one shareholder, which is the proprietor. So what the section 4713 says that because it is not treated as a transfer, therefore no capital gains. Obviously there are conditions, and if those conditions get violated, then 47A subsection 3 provides for framework that in the year in which there is a violation of the condition, then the entire amount which was claimed as exempt becomes taxable in the hands of the successor company. My belief is that in order to get implicated under 47A, first there has to be an exemption. If an exemption has been claimed and has been allowed to you, only then it will lead to a requirement that for a period of 5 years you have to maintain and comply with all the conditions. There is this decision of Prakash Electric Company which I do not quite agree with. So what are the critical issues? The critical issues is that succession is for business. Again, in a situation where you are trying to advise a professional, I think a professional cannot take the benefit of 4713 because business, the language clearly used is business, and as we know, business and profession, they are both separate. While one would like to believe that profession is also part of business because the same framework applies, but actually if you look at from a granular point of view, business and profession are different. The whole concept of what is succession, you have this earlier case law, Supreme Court of K.A. Chambers, which has brought out very nicely the principles, and I think those principles still apply, and therefore succession, which meets with the principles laid down by K.A. Chambers, is what we are referring to. When you are transferring, so in the 4713, there is actually a process of transfer of the business. So because it's not a conversion like a statutory vesting, you are actually transferring the business from the partnership firm to the corporate entity, and that transfer can be either in the form of a slump sale or an itemized sale. Irrespective of whether it is a slump sale or an itemized sale, if the whole conditions are satisfied, then the exemption clause section 47 will still be applicable, and therefore no tax implications. But in a reverse situation where there is a potential violation or if there is a violation, then in an itemized sale, if there are section 50 assets, they will give rise to short-term capital gains. And therefore, my advice to all of you is that try and structure this as a slump sale so that even if there is a violation, you don't get into a potential 30% tax liability, you only look at a 20% tax liability. I think one of the most important slides in this entire presentation, which is the difference between a 4713 and a chapter 21 conversion, is again for because of paucity of time, we might not be able to go into the details, but in the case of conversion under 4713, there is a transfer of business, and because there is a transfer of business, a business whose net book value is 10 crores, if the fair value is 100 crores, you can transfer it at 100 crores, and the company will allot shares worth 100 crores. Now, when the company allots shares worth 100 crores and it has actually bought the business at 100 crores, it's not a barter, you are structuring the conversion in such a way that the company is buying the business at 100 crores and issuing shares in discharge of the purchase consideration. In such a situation, again, the way the current regulations are, and we've had multiple case laws or multiple situations where we have done this. So far, it's been litigated, but unfortunately litigated in favor of the SSC. And some of the reasons, if I can just give in a couple of sentences, that if you look at all the processes of restructuring, so whether it be amalgamation, be it demerger, there was demutualization of stock exchange, which is also one of the provisions which is covered under 4713. So 4713, there is a subclause E which deals with this demutualization process. Now, under these processes, if you look at the relevant provisions of section 43(1), which defines actual cost, or when you look at 43(6), which defines WTV, there is a very clear-cut framework that in case of amalgamation, in case of demerger, in case of demutualization, so much so that in the case of a company getting converted into LLP, which is under 4713B, there are very express provisions to say that the WTV will be basis the WTV of the predecessor, and therefore depreciation is on the basis of what was the entitlement in the hands of predecessor. Whereas this is the only provision where either knowingly or unknowingly there is a loophole which is very clear, and basis this loophole it is possible, because this is a huge benefit. I would only advise it with a word of caution that it will be very, very clear in terms of your tax. And now that from April the GAR provisions will become applicable, and therefore you will have to also additionally apply the filter to ensure that the whole process of conversion was not driven for the sake of tax advantages, and therefore you will have to comply with the GAR filter as well. Again, on the hands of the successor entity, if you do a 4713 type of conversion, various issues can arise. So, for the assets which were forming part of the WTV of the predecessor, the depreciation in the first year will be pro rata. But if you have transferred the business of 10 crores at a value of 100 crores, the incremental 90 crores could be mainly because of intangibles. So, what happens to the depreciation on those intangibles? Whether that depreciation also gets pro rata, and if it gets prorated, then in the hands of the predecessors on the self-generated intangibles, there is no depreciation, no block existing. Again, a view which we have sought legal opinion from seniors, and a possible argument is that this limitation of proration of depreciation arises only in respect of assets which were forming part of the WTV of the predecessor. So if you have fresh assets which have been purchased by the successors, so post the conversion, if no plant and machinery gets added, is not subject to the limitations. Similarly, you can argue that for the intangibles which have been bought over, which were admittedly self-generated assets of the partnership firm, it's possible to argue that the limitation of the 6 proviso will not apply. Again, I would advise this with a little bit of caution. Important point here is 49(1)(3)(e). So earlier, the law was silent, and then there was an amendment on a retrospective basis. So it is, as far as land is concerned or non-depreciable assets are concerned, the WTV of the cost in the hands of the predecessor firm will still apply. So the only missing piece in this entire thing is the depreciable assets, and because of this, as I said, possible loophole in law, it's still possible to take, and there have been now multiple number of case laws, including some of the case laws which are now reported where we were the original advisors. So again, I think the belief is that you should still be entitled to benefit in of step up in the depreciation, especially for intangible assets. With the claim of higher depreciation on the basis of a step up, there is also a higher amortization, which higher depreciation which the company will need to provide in the books of accounts, and which will sort of reduce the the profits. So while the taxable profits also reduce, even the book profits also get reduced, which can have different implications, especially when the company is trying to do a private equity round, and therefore one needs to be aware of this implications. As we have said, accumulated losses, unabsorbed depreciation, even unabsorbed scientific research expenditure in 3514 will also get transferred. But lapsed losses of the firm will not get any. Again, a provision, if you read the relevant provision of 72A6, it tends to give a fresh lease of life, something which can be looked at as a benefit. As I said earlier, between chapter 21 and 47, 13, 14, the biggest difference is the stamp duty. So in case of Maharashtra, if you have removable properties, 5% stamp duty. If you do it as a slum sale, one of the participants was mentioning that Sharad is of the view that in a slum sale, the stamp duty could be quite too. I was not party to that presentation of Sharad, but I think one needs to look at the stamp duty implications for sure. I think we have discussed this, so I'll skip. So some of the other modes could be, you just set up a new company and let the old business die out. Especially when you are trying to convert businesses of professionals, advisors, doctors, architects, chartered accountants. This can become a much simpler method rather than actually doing a chapter 21 or a 4713 conversion. The only limitation is that there become a little vague issues in terms of how do you deal with the existing goodwill of the business. So again, my belief is that there is no provision under the law currently which compels you that the fair value of your business is more than the book value. You are not compelled to transfer it at the current fair value. The only exception is where you have land and building which is covered under 50C, or in the case of a builder, something which is covered under 43CA. And the last mode could be where you actually do a taxable transfer. So you are still transferring the business from the non-corporate to a corporate, but you are not taking the benefit of any of the incentive provisions under 4713 or chapter 21. Again, one will have to look at what the tax implications are before venturing into this. I will not deal with this slide. Suffice it to say that in my view, a corporate in the process of conversion, the business is transferred to a new company which is set up post March 16. If you look at the language of the new section 115BA, it's possible to take a view that because there are no requirements that the business is not should not be formed out of any restructuring, it's possible to take a view that such a business will be entitled to 25% tax liability under the new provisions of 115BA. So I think this is another point where I believe some debate is possible, especially when you are trying to look at chapter 21 conversion versus a 4713 conversion. In the case of a chapter 21 conversion, this is what I would call a succession of the entity. So if you look at the recent circular says that if there is a succession of a firm or a sole proprietary concern into a company, then the cost has to be cost on the basis of the book value in the hands of the predecessor. So in a case of a 4713 conversion where a 10 crore net book value of business is transferred to the corporate entity at 100 crores, and obviously if you are purchasing the business worth 100 crores, the requirement of 4713 is that you have to issue shares worth 100 crores, you cannot pay cash. So you would have issued shares worth 100 crores. And therefore the cost in the hands of the shareholder would be the 100 crores and not the 10 crores. If in such a case, if there were to be a buyback of shares, whether the cost for the shareholder becomes 10 crores, when you are trying to apply 115 QA, whether for the company which is liable to pay this buyback tax, similar to a dividend distribution tax, whether the cost is 10 crores versus 100 crores, at least an argument which is possible that in case of a 4713 conversion, it is not succession of the entity, it is succession to our business. And therefore, possible to argue again, because this is a new rule which has got notified earlier this year. I would advise a lot of caution. It's a possible view, and therefore more evaluation is necessary. So in nutshell, if you look at what is the comparison, I think the slide is pretty obvious. In case of capital gains, in Chapter 21 there is no capital gains applicable, whereas in the case of 4713 the capital gains would be applicable subject to you fulfilling the conditions of 4713 and therefore claiming an exemption. Similarly, both 45(4) implications are not applicable. Depreciation you already dealt with. Exemption for capital gains on succession of profession. In the case of Chapter 21 conversion, it is possible. In case of 4713, as we discussed, it's not applicable to our profession. And stepped up cost of shares in the 4713, again possible. Chapter 21 conversion step up in cost of the share not possible. I think this slide is also pretty obvious. So I would like to end with something which is topical, that November 8, the country went through a huge process of conversion. And different forms of conversions have happened. Some of us, we have been alive to the whole process. As I said at the beginning, that there is a cross process and there is a subtle process. When this demonetization has been introduced, while the obvious cross process was converting the old notes into new notes, somewhere the Prime Minister has been driving the subtle changes in the mindset of the taxpayers of this country, and to what extent that subtle process of conversion has been actually transferred from the Prime Minister to the taxpayers of this country is yet to be seen. So subject to the limitations of time, I think we discussed. If there are any questions, I would be happy to discuss during the break. Thank you all for a very patient hearing.
With the aroma of food already spreading, I think we have time for one question if somebody has one. Umesh, that is proof that you explained everything which was possibly explained. One question, it's a case of a partnership firm owning a hotel, having 4 partners. 2 partners first of all retire and 2 partners come in. After some time, 2 other original partners also retire and 2 other partners come in. So it's a wholesale actually change of business. But to avoid tax, it's given in the shape of retirement. Later on, it's converting to a private limited company. Is it taxable at any stage?
You are asking me a black and white answer for something which is very grey. I think again, the theoretical answer is that subject to doing the process of the admission of those 2 partners with a lot of commercial justification. If you look at the regulatory provisions still will permit you the transfer of the business from the erstwhile 4 partners to a new set of 4 partners. Again, there are, based on the current provisions, there would not be any tax implications, provided the whole process is done properly enough and people don't you don't see that this has been done as a culpable device. So once you go into the new GAR provisions, this will become extremely difficult. While it might be within the four corners of the law, it might become very difficult.
GAR will be the law.
Before I ask Mehul to propose a very well-deserved vote of thanks, friends, immediately after lunch we have a very well-curated panel discussion, some excellent panelists who are going to be here.